There is an invisible, high-tech corporate dragnet sweeping across the state of California right now, and it is systematically stripping everyday citizens of their homeownership status without a single human interaction. For generations, buying a home here was the ultimate symbol of middle-class success and financial independence. You assumed that as long as you maintained your property and paid your local taxes, your asset was completely secure. But in 2026, major corporate insurance syndicates have quieted down their traditional field teams and deployed artificial intelligence vultures instead. High-altitude satellites and automated observation drones are scanning your roof, your yard, and your trees from miles above the earth. Your private property is no longer acting as a secure sanctuary for your family retirement layout. It is converted into a data point for a software algorithm programmed to cancel your protection. And this is where things get ugly. Imagine coming home from work on a standard Thursday evening and opening your traditional mailbox. Inside is a cold, automated notification from your home insurance provider of 15 years. The letter does not congratulate you for your loyalty. It states that your property protection will be permanently cancelled within 30 days. You call the corporate hotline in a panic, asking to speak to the local representative who handled your file. But the representative knows absolutely nothing about your case because a human inspector never stepped foot on your grass. The cancellation was triggered by an autonomous satellite filter that detected a cluster of aging oak branches hanging over your roofline. Internal insurance trade data shows that over 35% of non-renewals across suburban sectors are now generated by these automated aerial sweeps. The mainstream business channels continue to produce feature segments praising how technology is streamlining corporate operations and reducing industry waste. But the ground-level reality is a terrifying tech purge that leaves long-term homeowners completely vulnerable to immediate financial ruin. Would you continue to invest your weekly income into a residential asset where an unverified computer scan can invalidate your lifestyle security overnight? Granted, households located within newly developed master-planned cities feature clear grid layouts that easily clear these automated risk filters. Yet, for the traditional suburban infrastructure that houses the true working class, this invisible scan initiates a countdown to distress. Many independent consumers believe that if they just maintain their structure and lock their security fences, their privacy remains intact. But in today's corporate landscape, property lines mean absolutely nothing to a high-altitude data collection syndication. The software models do not just check your roof tiles, they analyze your entire lifestyle perimeter. The computer flags a routine stack of firewood near your garage, a temporary plastic tarp over a boat, or slightly discolored grass. The system automatically categorizes these everyday items as extreme fire hazards or structural degradation. Once the algorithm applies that negative risk label to your file, the system blocks you from accessing standard retail rates. The politicians' distribution statements claiming these digital tools are essential to introduce modern accuracy into the underwriting process. But the real-world consequence is a complete loss of consumer control, as independent families are left with zero path to appeal the automated decision. Do you believe it is reasonable for a corporate software algorithm to possess the absolute authority to blacklist your home from the general market? Naturally, insurance syndicates must balance their macro capital exposure to prevent absolute treasury insolvency when a wildfire burns through a canyon. But this rigid reliance on automated data points is shifting the entire burden of risk directly onto the backs of the consumer base. When these computer models process an entire community and tag it with an extreme hazard classification, the local market paralyzes. It is no longer an individual issue affecting a single household on the block. Entire zip codes are being quietly placed into an institutional freeze that destroys local real estate transactional value. When the largest private carriers withdraw their operations from a specific zone, no traditional buyer can secure a loan to move in. The global commercial banks refuse to clear a standard 30-year mortgage if the underlying collateral cannot secure private protection. The lifestyle magazines continue to run cover stories celebrating California land as a guaranteed generator of generational wealth. But on the ground, everyday working professionals are trapped inside homes that they can no longer sell on the open market. Would you risk your entire life savings to buy a beautiful suburban home if you discovered that global lenders had blacklisted the area? To be fair, global sovereign wealth groups and mega landlords are happy to see these transactional freezes because it lowers the cost of land acquisition. But for a regular middle-class family whose net worth is locked inside their home equity, this credit blockade is an absolute catastrophe. When ordinary homeowners find themselves completely locked out of the private market, they turn to the state option of last resort, the California Fair Plan. They assume that because a state-mandated program manages the pool, their family budget will finally receive stable, consumer-first protection. But in 2026, this public safety net is suffocating under an unprecedented avalanche of forced applications. As thousands of satellite-dropped consumers flood the program every single month, the public ledger is hitting a wall. To keep the system from facing immediate insolvency, administrators are forcing historic premium increases directly onto the policyholders. Homeowners are opening their new public statements to find their annual insurance bills have tripled, matching the cost of their actual property taxes. The corporate headlines frame this public program as a vital shield designed to protect the working class from market volatility. But the practical reality is a financial mirage that demands premium pricing while offering highly restrictive structural coverage definitions. How long could your independent family savings survive if your fixed housing overhead suddenly demanded an $8,000 cash infusion? Of course, wealthy individuals who possess multiple streams of global passive income can absorb these state premium spikes without shifting their lifestyle. But for the independent teacher or retired professional, this public cost trap delivers them directly to the mortgage foreclosure engine. As these forced insurance costs drain the remaining checking accounts, desperate consumers attempt to drop hazard coverage completely to protect their cash flow. They assume that going unprotected is a viable short-term strategy to keep food on the table while they figure out a long-term plan. But if your home carries an active banknote, the global lending syndicates will never allow you to drop coverage. The banking compliance departments use automated data links to monitor the insurance status of their entire loan pool every 24 hours. The moment the computer confirms your private or public policy has lapsed, the bank triggers force-placed insurance. The institution purchases an expensive, low-quality commercial contract from their own corporate affiliates and adds the bill to your mortgage. These forced policies cost up to 4 times more than standard protection, yet they provide zero personal liability coverage for your family. If your household budget fails to cover this new inflated monthly amount, the automated foreclosure machine immediately activates. The real estate influencers always marketed a long-term mortgage as a reliable foundation for middle-class wealth and retirement security. But inside a market controlled by algorithmic risk tools, that contract operates as a financial trap that can liquidate your equity overnight. What path do you possess when a corporate banking algorithm holds the absolute power to double your housing debt without your permission? Obviously, wealthy cash buyers who hold complete title to their luxury estates stand completely outside this institutional foreclosure cycle. But for the traditional working class, this constant automated intimidation is triggering a historic tech-driven migration. This systematic extraction of independent family equity is driving a massive population shift out of the coastal territory. An exodus of displaced middle-class capital fleeing the uninsurable sectors of the state. Internal demographic data from the Census Bureau is tracking an explicit pattern of long-term residents quietly executing an exit strategy. Families are liquidating what they can, packing up moving vans, and relocating to interior states like Nevada, Arizona, Idaho, and Texas. They aren't leaving because they grew tired of the local culture. They are leaving because the cost of corporate surveillance has broken their budget. The regional politicians love to hold press conferences, celebrating the expansion of high-tech artificial intelligence startups inside the metro centers. But they remain completely silent about the steady departure of the essential workforce, the nurses, the utility technicians, and the local mechanics. A regional economy that liquidates its own productive middle class cannot sustain its long-term real estate valuations. Naturally, regional demographic rebalancing is a normal corrective mechanism within a hyperinflated territory, and landlocked service sectors continue to show employment growth. Yet, this steady flight of independent families is leaving a permanent scar on the core fabric of the local community infrastructure. If you are watching this investigation from a quiet neighborhood in Texas, Florida, or the Midwest, do not make the mistake of looking away. This is not a localized California story. This is the structural blueprint for an unaffordable America. The identical risk matrices and corporate financial tools are being deployed inside your home states right now. The private insurance syndicates are rewriting the terms of property ownership from coast to coast, turning homes into elite commodities. The government agencies continue to publish optimistic statements, claiming the national financial system remains perfectly resilient. But the data on the ground proves that the core foundation of middle-class wealth is fracturing under the weight of hidden costs. Take a hard look at your own property renewals, escrow balances, and local tax assessments this quarter. Are you starting to notice the early indicators of this economic squeeze appearing inside your own zip code? Share your local numbers and your personal experiences in the comments section below, so we can track how fast this system is expanding across the nation. The United States has historically adjusted to structural shocks, and new legislative boundaries may eventually step in to protect the consumers. But before those macro protections arrive at your front door, independent homeowners must see the reality of the trap clearly. Subscribe to remain informed, protect your wealth, and we will see you in the next report.